Warren Buffett owns 42.6% of a company that Wall Street absolutely hates right now. Another one of his holdings pays a massive 6.5% dividend and is about to split into two companies. And he just spent the last year quietly building a 9.2% position in a third stock that everyone thinks is dead money. These three stocks could be sitting on massive upside. Let me show you why Buffett is betting big while everyone else is running away. Since taking over Berkshire Hathaway in 1965, Warren Buffett has delivered nearly 20% annualized returns. That's absolutely legendary performance that's made countless investors rich. His secret? Buy wonderful businesses at fair prices. But today, we're looking at something even better: wonderful businesses at UN fair prices. These three stocks are so beaten down that the opportunity could be extraordinary. Let's break down each one, starting with Buffett's biggest bet. Stock number 1, DaVita, ticker DVA. This isn't just a stock Buffett likes. Berkshire Hathaway owns 42.6% of the entire company. Think about that, nearly half. He's been holding this position for over a decade, doubling and tripling down while others sell. So what does DaVita do? They operate kidney dialysis centers across America. Not sexy, not exciting, but absolutely essential healthcare. Here's what Wall Street hates. Recent quarterly earnings have disappointed. The stock has been beaten down badly. Investors are fleeing. But here's what Wall Street is missing. DaVita now trades at just 10 times forward earnings. Let that sink in. Meanwhile, analysts are projecting earnings growth of 11% in 2025 and 17% in 2026. You're getting a company with double-digit growth forecasts for the price of a dying business. That's a massive disconnect. Plus, three huge tailwinds are working in DaVita's favor. First, the company is aggressively buying back shares. Every quarter, your ownership percentage grows without you doing anything. Second, they're expanding internationally, creating organic growth outside the US market. Third, and this is the big one, the number of Americans with chronic kidney disease keeps increasing. This is a long-term demographic trend that isn't reversing. Buffett sees a wonderful business temporarily out of favor. That's when he backs up the truck. Stock number 2, KRAFT HEINZ, ticker KHC. I'm going to be completely honest with you. Even Buffett admits this investment hasn't worked out as he hoped. Berkshire owns 27.5% of the company and probably overpaid years ago. So why am I telling you to consider it? Because you can buy it at a price Buffett wishes he could get. KRAFT HEINZ trades at just 9 times forward earnings. That's the cheapest stock in this entire video. How cheap is that? General Mills trades at 14 times earnings. Kellanova trades at 21 times earnings. You're getting a similar business at a 35–50% discount to competitors. But here's where it gets really interesting: the dividend. At current prices, KRAFT HEINZ pays over 6.5% annually. That's not a typo. 6.5%. Let's do the math. Invest $10,000, collect $650 per year in dividends, paid quarterly. That's real money hitting your account every 3 months while you wait for the stock to recover. And about that recovery, there's a major catalyst coming. KRAFT HEINZ plans to split into 2 WO separate public companies. Why does this matter? Because corporate split-ups often unlock massive value. Look at what happened with Kellanova when it split from Kellogg. Shareholders made out very well. The same playbook could work here. So you've got 3 things going for you: rock bottom valuation, massive dividend income, and a restructuring catalyst. That's a pretty compelling setup. Stock number 3, Pool Corporation, ticker POOL. This one is fascinating because it's a recent Buffett buy. Over the past year, Berkshire built up a 9.2% stake. When Buffett makes a fresh investment after sitting on $300 billion in cash, smart investors pay very close attention. Pool Corp supplies everything needed to build and maintain swimming pools. Construction materials, chlorine, filters, pumps, maintenance supplies. If it goes in or around a pool, they sell it. Now, here's the situation. The housing market slowdown crushed demand for new pools. Earnings dropped hard. Over the last 12 months, earnings per share came in around $11. Compare that to 2021 to 2023, when the company was averaging $16 per share. That's a 30% drop, and Wall Street punished the stock accordingly. But here's what Buffett sees, and I think it's brilliant. Point 1. All those pools built during the boom years still need maintenance. That creates beautiful, recurring revenue from supplies and chemicals. This isn't one-time revenue, it's year after year after year. Point 2. Once housing stabilizes and new pool construction normalizes, you've got two revenue streams working: new pool builds and a growing base of existing pools needing maintenance. Point 3. This is a steady, predictable business with pricing power. Pool owners can't just stop maintaining their pools. The revenue is sticky. Now, at 27 times forward earnings, this isn't a dirt-cheap value play like DaVita or KRAFT HEINZ. The market is already pricing in some recovery. But if earnings normalize back toward that $16 level, and Buffett clearly believes they will, you could see 40–50% upside from here. Plus, here's a bonus. Pool Corp has raised its dividend for 14 consecutive years. They currently yield 1.75%. It's not a high yield, but that consistent dividend growth tells you management is confident in the business fundamentals. They're not worried about the future. All right, let's put all three side by side so you can see which fits your strategy. DaVita. This is the deep value play. Lowest valuation at 10 times earnings. Highest Buffett conviction with 42.6% ownership. Projected double-digit earnings growth. But also, the most controversy and risk. KRAFT HEINZ. This is the income investor's dream. Massive 6.5% dividend yield. Cheapest valuation at 9 times earnings. Plus that restructuring catalyst coming. Perfect if you want to get paid while you wait. Pool Corporation. This is the recovery play. Fresh Buffett buy signals new conviction. Steady long-term growth model. Dividend growth track record. Higher valuation, but cleaner story. 3 different strategies. 3 different risk-reward profiles, but all share one critical factor. Warren Buffett sees value where Wall Street sees only problems. Now, let me be brutally honest about the risks, because they're real. DaVita faces regulatory scrutiny in healthcare. Government policy changes could hurt margins. KRAFT HEINZ operates in a low-growth, highly competitive industry. Consumer tastes are shifting away from packaged foods. Pool Corp depends entirely on housing market recovery. If that takes longer than expected, earnings stay depressed. And remember, even the Oracle of Omaha makes mistakes. His own admission about overpaying for KRAFT HEINZ proves nobody's perfect. These are long-term value plays, not quick flips. You need patience and conviction. If you can't handle volatility, these aren't for you. Here's what ties all three together. They embody Buffett's core philosophy of being greedy when others are fearful. Right now, investors are fearful about DaVita's earnings, fearful about KRAFT HEINZ's competitive position, fearful about Pool Corp's housing exposure. But fear creates opportunity. These aren't speculative tech startups or meme stocks. They're established businesses with real cash flows, real assets, and real competitive advantages. The question is, do you have the conviction to buy what everyone else is selling? Buffett built his fortune doing exactly that. He doesn't buy what's popular, he buys what's undervalued. At 10 times earnings for DaVita, 9 times for KRAFT HEINZ, and 27 times for a recovering Pool Corp, the valuation suggests significant upside if, and this is key, if market sentiment eventually shifts. So here's my question for you. Which of these 3 fits your investing strategy? Are you a deep value hunter attracted to DaVita's 10x earnings? Are you an income investor salivating over that 6.5% KRAFT HEINZ dividend? Or are you a growth at reasonable price investor betting on Pool Corp's recovery? Drop a comment below and tell me which stock you find most compelling and why. I read every single comment and love debating investment theses with you. If this analysis added value to your investing research, hit that like button. It tells YouTube to show this to more investors who could benefit. And if you want more deep dives into legendary investor portfolios, Buffett, Ackman, Burry, Dalio, subscribe and turn on notifications. I break down their moves every single week so you can learn from the best. The link in the description has more resources on value investing and Buffett's strategy. Check it out if you want to go deeper.